Welcome to the Deep Dive, where we cut through the noise and arm you with the crucial insights to master complex topics. We take a stack of sources, pull out the most important nuggets, and give you a real shortcut to being truly well-informed.
Yeah, a shortcut through the complexity.
Exactly. Today, we're tearing down the jargon and diving deep into the very foundation of corporate ownership,
Hmm.
equities. Our mission is to demystify how companies raise capital, unpack the different types of stock, understand what rights shareholders actually have, and even touch on the crucial rules that govern their trading.
That's right. Whether you're prepping for a big meeting, looking to grasp the fundamental mechanics of the financial world, or just, intensely curious about how companies are structured and funded, this deep dive is designed to deliver those aha moments.
Aha moments, I like that.
You'll walk away with a clear, concise understanding of what it truly means to be an owner in the corporate landscape.
So let's pull back the curtain on our starting point, the corporation itself. Our sources really underscore that a corporation isn't just a big business, it's a separate legal entity.
A legal person almost.
Yeah, exactly. It can do many of the things you or I can do: buy property, obtain loans, sue, and even be sued. It has its own legal life, distinct from its owners.
And this legal separation is, well, profoundly important because it leads directly to the concept of limited liability for shareholders.
Limited liability, key term.
Right, because the business is its own legal person. You, as an individual shareholder, are generally not personally responsible for the corporation's debts.
So if things go south,
If the business fails, the most you can lose is your original investment. Your personal assets, they remain protected. This foundational concept is arguably what made modern capitalism possible, allowing individuals to invest in risky ventures without, putting their entire personal fortune on the line. It really fueled innovation and growth.
it's a huge protection for investors, definitely. So even with all that legal formality, the basic corporate organization remains quite straightforward, doesn't it?
Pretty much, yeah.
Shareholders, that's you if you own stock, elect a board of directors.
The BOD.
Right, the BOD. That board then oversees the company's operations and appoints its senior managers. It's a pretty clear structure, keeps things accountable.
Exactly. Once a corporation is formed and operating, it will inevitably need capital, right, to fund its ongoing operations or maybe expansion.
Always need money.
And this brings us to a fundamental choice companies face: debt financing versus equity financing.
Okay, debt versus equity. We all understand the concept of a loan, but for corporations, raising debt often means selling bonds.
Issuing bonds.
When a company sells bonds, it's essentially borrowing money from investors for a set period, obligating itself to make regular interest payments to those bondholders throughout the life of the bond.
And crucially, bondholders are creditors, not owners. That's a big difference.
Right, no ownership stake.
They don't have voting rights in the company, and their returns are limited to the interest payments they receive. There's a clear repayment schedule, but also, a limit to their upside.
But then you have the other side, equity financing, issuing stock.
Right.
And this is where it gets really interesting for you as an investor, because purchasing stock immediately makes you a part owner of that corporation.
An owner. Unlike bonds, there are no guaranteed interest payments or fixed maturity dates. It's a different kind of commitment, really, for both the company and the investor.
So what's the hook for the investor then?
Well, the upside for equity investors is significant. The potential to share in the company's profits, either through dividends.
Share distributions of cash or sometimes more stock.
Exactly. And perhaps more importantly, the potential for your shares to increase in value if the company prospers. Growth.
Growth, yeah. But there's a flip side, right? A
Yeah.
downside.
Oh, definitely. There's a significant downside to consider, especially when we talk about the order of liquidation.
Liquidation. Okay, so when things go really wrong, bankruptcy.
Yeah, Chapter 7 bankruptcy. If a company unfortunately fails and is forced to liquidate its assets, bondholders and other creditors have a higher claim to the company's assets. They get paid first,
Always the creditors first.
which means shareholders are generally the last in line and sadly are the most likely to lose their entire investment.
Ouch.
It's a higher risk, definitely, but that comes with that higher potential reward we talked about.
Makes sense. Risk and reward. Now let's delve into common stock, which you said is truly the backbone of ownership.
It really is. This is the traditional basic unit of corporate ownership, the most widely issued type of stock, and typically the first a corporation issues.
And as we just discussed, when it comes to the capital structure, common stockholders are At the bottom of the payment totem pole in a liquidation scenario.
Dead last, basically.
They only receive dividends after bond interest and any preferred dividends have been paid. So yeah, last in line.
You might also encounter par value when looking at common stock. For bookkeeping purposes, stock is usually issued with an arbitrary par value, often a very small figure, like $1 or even less.
Par value sounds important, but is it?
Well, for you, the investor, it's largely an accounting formality. The real value is always dictated by the market, supply and demand, not this arbitrary figure.
Okay, so don't get hung up on par value for common stock. Good to know. It's quite a journey for a share, isn't it? From being just a legal possibility to actively trading on the market.
It is, yeah.
Let's talk about how shares are tracked from their initial authorization all the way through to what's actually held by investors.
Okay.
Authorized shares are the maximum number of shares a company is legally permitted to issue when it's incorporated. This number can only be changed by a majority shareholder vote and by revising the corporate charter.
And companies often keep a reserve of unissued shares, right,
Yeah.
for future needs like acquisitions or stock options.
Right, they don't usually issue everything at once.
Then you have issued shares, which are simply the shares that have actually been sold or distributed to the public out of that authorized amount.
Issued means they're out there.
Any shares that haven't been sold are just called unissued shares. Pretty simple.
And what about these shares a company buys back? That seems counterintuitive. Why would a company do that? Our sources refer to this as treasury stock.
Ah, treasury stock, yes. This is when a company repurchases its own shares that were previously issued.
Why, though?
Oh, various reasons. Maybe they think the stock is undervalued, maybe for employee stock plans, or to reduce the number of shares outstanding and boost earnings per share.
Interesting. So what happens to those shares?
While these shares are held by the company in its treasury, they have no voting rights and receive no dividends. It's essentially stock put on pause.
Okay, paused stock.
That leads us directly to outstanding stock. This is the crucial number for investors. Issued shares minus any treasury stock.
Issued minus treasury equals outstanding.
Correct. These are the shares that do receive dividends and have voting rights. They're the ones actively in the market, held by investors like you.
Let's use an example to make this concrete. Imagine ABC Corporation is authorized to issue 10 million shares.
Okay, big potential pool.
They've only issued 4.5 million shares to the public. Later, ABC repurchases 500,000 shares for its treasury.
Taking some back off the market.
Right. This leaves ABC with 4 million shares outstanding. Those 4 million are the shares actively held by investors, receiving dividends and voting rights.
And this directly connects to a company's market capitalization, or market cap. That's how a company's size is often determined.
Market cap. You hear that term all the time.
You just multiply the current market price of the stock by the number of outstanding shares. So those 4 million outstanding shares from our ABC Core example are what drives their market cap, combined with the share price, of course.
Got it. So outstanding shares are key for market cap. Now, if you're a common shareholder, what rights do you actually have? Seems important.
Very important. Our sources list several key rights. Okay, like what?
Well, there's the right of inspection, which means you have the right to inspect certain company books and records.
Can I just walk in and demand to see the books?
Not quite like that. It's typically exercised by receiving an audited annual report. You get the key financial information that way.
Ah, okay. The annual report makes sense. What else?
Then there's the right to receive dividends. Now, as we said, they're not guaranteed.
Right, the board decides.
But it is your right to receive a portion of the company's profits if the board of directors decides to distribute them.
Okay, the right if they pay. You also have the right to evidence of ownership. Right, proof that you own it.
Exactly. You're entitled to receive a stock certificate as proof, though nowadays it's often held electronically in street name by your broker.
Okay, but the proof exists. What's on it?
It lists the company, your name, the number of shares, and important details like the transfer agent. And like a check, you typically have to endorse it or instruct your broker when you sell it.
And of course, right of transfer. You can sell your shares, right? Generally, yes. You can freely transfer your shares by selling, gifting, or even bequeathing them. Freedom to trade is fundamental.
But are there exceptions?
Yes, it's important to note that certain circumstances, like pre-initial public offering or IPO shares or compensation shares, may restrict transferability for a period.
Ah, the lockups we hear about.
Exactly. These often carry a legend or warning printed right on the certificate or noted electronically, indicating they're not eligible for immediate transfer. usually tied to rules like Rule 144.
Okay, we'll get to Rule 144. But first, let's really dive deeper into the right to vote, because this is where a lot of the power of ownership truly lies, doesn't it?
It really does, at least in theory. Common stockholders generally vote on significant issues.
Like what kind of issues?
Electing board members, approving stock splits, authorizing major things like mergers or acquisitions, big picture stuff.
Okay, so shareholders vote on stock splits.
Well, they vote on authorizing the company to do a stock split. But it's really important to clarify that shareholders do not determine if cash or stock dividends are paid.
Ah, that's a key distinction. Who decides dividends then?
All dividend decisions are made solely by the board of directors, period.
Okay, board decides dividends.
Got it.
And your voting power.
It's directly based on the number of shares you own. If you have 100 shares, you get 100 votes per issue. Simple as that.
And if you can't make the annual meeting in person,
You can cast your votes by proxy. You authorize someone else, usually management or someone you designate, to vote on your behalf.
makes sense. And companies can even have different classes of common stock, right? Not all common stock is equal.
That's right. You often see Class A and Class B shares. Class A common typically grants full voting rights, one share, one vote.
And Class B.
Class B stock might have no voting rights or limited rights, or sometimes even super voting rights, where one share gets, say, 10 votes, often used by founders to maintain control.
Ah, okay. So Class A, with the standard voting rights, is generally more valuable.
Generally, yes, because that voting power has value.
Now, when it comes to how votes are cast, the mechanics, there are two main methods mentioned: statutory voting and cumulative voting.
Correct. And they have very different impacts, especially for smaller investors.
Okay, let's start with statutory voting. How does that work?
With statutory voting, shareholders get one vote per share for each voting issue, or each board seat up for election.
One vote per share per seat.
Exactly. This method clearly benefits larger or majority shareholders because their sheer number of shares gives them more influence on every single decision, every single seat.
So if I'm a smaller investor, say with 100 shares, and a big institution has 100,000 shares, under statutory voting, my 100 votes for my preferred candidate don't count for much against their 100,000 votes for theirs on each seat.
Precisely. It makes it tough for minority shareholders to get representation on the board if the majority votes as a block.
Is that why cumulative voting exists? To balance things out?
Exactly. Cumulative voting is designed to give smaller or minority shareholders a fighting chance, but potentially gain some board representation.
How does that work then?
Here, you multiply your total shares by the number of voting issues, or board seats open. That gives you a total pool of votes.
Okay, shares times seats equals total votes.
Right, and you can cast that total pool of votes in any way you wish across the candidates or issues.
Yeah.
You can concentrate them.
I see. So let's use the XYZ Corporation example. They're electing 3 board members. An investor has 1,000 shares.
Okay.
Under statutory voting, they cast 1,000 votes for candidate A, 1,000 for B, 1,000 for C.
Correct, 1,000 per seat.
But with cumulative voting,
That same investor gets 3,000 total votes, 1,000 shares, multiplied by 3 seats.
and they can do what with those 3,000 votes?
They can cast all 3,000 votes for a single candidate if they want to, or split them 1,500, 1,500, or however they choose.
Wow, okay. That gives a significant advantage if they strongly support just one person or want to ensure at least one minority-favored director gets elected.
Yes, it allows for that strategic allocation of votes, offering more proportional representation potential for smaller shareholders. Not all companies offer it, though.
Good point. Need to check the company's rules. This brings us neatly into restricted securities and the Securities and Exchange Commission's, or SEC's, Rule 144. Sounds a bit technical.
It is a bit, but crucial for understanding how certain shares get sold into the public market.
Our sources explain lockup agreements for pre-IPO investors, meaning those who invest before a company's initial public offering. People like private placement buyers, management, venture capitalists.
Right, the early money. These agreements prevent them from immediately selling their shares right after the company's IPO, typically for about 6 months, sometimes longer.
Why the lockup?
It's designed to prevent these early investors, who often got shares cheaply, from dumping them right after the company goes public. That could flood the market and crash the price for everyone else. It promotes stability.
Makes sense. And these shares often have that restrictive legend you mentioned earlier.
Exactly. Because they haven't been registered with the SEC for public sale initially, they get this legend printed on them, physically or electronically. It says they aren't eligible for resale until certain conditions are met, often under SEC Rule 144.
Okay, so let's talk Rule 144. What does it regulate?
SEC Rule 144 is really important because it governs the sale of two main types of securities into the public market. First, restricted securities, which are unregistered shares, usually acquired in private placements or other non-public transactions.
Okay, restricted means unregistered.
And second, control securities. These are registered shares, but they're held by insiders affiliates of the company, like officers, directors, or anyone owning more than 10% of the stock.
So restricted stock is about how you got it. Control stock is about who you are.
Nicely put, yes. Both types generally must be sold according to Rule 144's requirements. It's designed to prevent market disruption when insiders or private investors sell large blocks of shares, ensuring an orderly market.
What are the key requirements? Is there a waiting period?
Yes, for restricted securities of a company that files reports with the SEC, there's generally a 6-month holding period. This period starts only once the securities are fully paid for.
6 months for restricted stock. What about control stock?
Interestingly, for control stock acquired in the public market, like an officer buying shares on the NYSE, there's no holding period under Rule 144 itself, though other insider trading rules always apply. But other Rule 144 conditions do apply to the resale.
Okay, so holding period mainly for restricted. What else do you have to tell the SEC?
Generally, yes. If you're intending to sell either restricted or control securities, you usually have to notify the SEC by filing Form 144 when you place your sell order with the broker-dealer.
Filing a form.
Right. This notification then provides you with a 90-day window to sell those shares within certain limits.
Are there exceptions to filing?
Yes, there's an exemption for small sales. If the sale is under 5,000 shares and the total value is no more than $50,000, then you don't need to file the form.
Okay, a small sale exemption. What about volume limits? Can insiders sell huge amounts at once?
No, generally not. Beyond the notice, there's also a volume limitation for control persons selling stock of exchange-listed companies. This is another key safeguard.
How does that limit work?
Within any 90-day period, the affiliate can sell the greater of two amounts, either 1% of the total shares outstanding or the average weekly trading volume during the 4 weeks preceding the filing of Form 144.
Okay, the greater of 1% outstanding or the 4-week average volume. Let's use the example. Issuer has 7 million shares outstanding. Average weekly trading volume was 60,000 shares.
Right. So 1% of 7 million is 70,000 shares. The 4-week average volume is 60,000 shares,
So the holder can sell the greater of those two.
which is 70,000 shares in that 90-day period. That's the maximum under Rule 144.
Got it. So Rule 144 provides an orderly process for restricted and control stock to enter the market. Shifting gears now, stocks are often classified in various ways, right? Like giving them profiles.
Yeah, definitely. Understanding these classifications isn't just about labels. It's about getting a sense of how a company might perform in different economic climates and aligning investments with your personal risk tolerance and financial goals.
What are they based on?
Things like company size, the type of industry, risk level, expected return, or how closely they follow the ups and downs of the business cycle.
Okay, let's run through some common ones. First up, blue chip stocks. Sounds fancy.
They usually are. These are high-grade issues from major well-established companies with long, consistent records of earnings and dividends. Think big, stable companies known for financial strength.
The reliable giants.
Okay.
Then growth stocks.
These are companies whose sales, earnings, and market share are expanding faster than the general economy. They're often aggressive, maybe tech or biotech, very research-minded.
Do they pay dividends?
Usually not much, if any. They do retain most of their earnings for expansion, reinvesting back into the business for, well, future growth. That's the focus.
Makes sense. Next, defensive stocks. What makes them defensive?
These are companies resistant to recessions. They provide necessary services, like utilities, or produce consumer staples, things people buy regardless of the economy.
Like food, medicine.
Exactly. Tobacco, pharmaceuticals, soft drinks, food essentials. They tend to hold up relatively well when the economy slows down.
And you made a key distinction earlier. Don't confuse a defensive stock with a defense stock.
Right. Very different. A defense stock is from a company making military equipment, which might behave very differently. Defensive stocks are about economic defense, not military defense.
Got it. Then we have income stocks. Seems self-explanatory.
Pretty much. These are issued by companies that pay higher than average dividends relative to their market price. They're attractive if you're seeking current income rather than, say, maximum capital appreciation. Utilities often fit here too.
So steady income stream. And finally, cyclical stocks.
These are the opposite of defensive, really. Cyclical companies see their earnings fluctuate directly with the business cycle.
So they do well when the economy is booming.
Exactly. They perform well when economic conditions improve and their stock price tends to rise. Think heavy industry, construction, autos, appliances.
But when things slow down,
When conditions deteriorate, their business declines sharply, causing their stock price to drop more significantly than the overall market. High highs, low lows, following the cycle.
okay, that classification system helps frame different investment strategies. Our deep dive wouldn't be complete without discussing American depository receipts, or ADRs. What are these?
ADRs are fascinating, actually. They basically allow you to trade foreign stocks right here in the United States on U.S. exchanges.
So if I want to invest in, say, a big German company without dealing with the Frankfurt Exchange or euros,
ADRs are likely your answer. An ADR represents a claim to foreign securities with the actual underlying shares held safely by U.S. banks overseas in custody.
so I own the ADR, the bank owns the actual shares abroad.
Essentially, yes. The ADRs trade in U.S. markets, either on major exchanges like NYSE or NASDAQ, or over-the-counter, OTC, and crucially, they're priced and pay dividends in U.S. dollars. Makes it much simpler for U.S. investors.
Do ADR holders get all the same rights as direct shareholders?
They have dividend rights, yes. But it's important to note they generally do not directly receive preemptive rights if the foreign company issues more stock. The bank holding the shares might handle that.
And I heard there are sponsored versus unsponsored ADRs.
That's right. A sponsored ADR is when the foreign company itself actively participates and pays a depository bank to issue the ADRs in the U.S.
Why would they do that?
It allows them to raise capital here and list their ADRs on major exchanges, increasing visibility and access to U.S. investors. Many of the largest, most well-known ADRs are sponsored.
And unsponsored.
With an unsponsored ADR, a depository bank issues the ADR without the foreign company's direct involvement or payment.
Oh.
These typically trade in the OTC market, and there might be multiple unsponsored ADRs for the same foreign stock.
Interesting distinction. Now, let's turn our attention to preferred stock. You mentioned it earlier, it's kind of a hybrid investment.
Yeah, it sits somewhere between bonds and common stock in the hierarchy. Our sources tell us that preferred stock is senior to common stockholders in the capital structure.
Meaning they get paid before common shareholders in bankruptcy.
Yes, and also usually for dividends. However, they still rank below bondholders regarding claims on assets in bankruptcy, and usually for payments, too.
So, middle ground. Who typically buys preferred stock?
It's often issued by established companies and is generally suitable for investors primarily interested in income rather than big capital appreciation, kind of like income-focused bond investors, but with equity characteristics.
Do they get voting rights like common shareholders?
Generally, no. Preferred shares typically lack voting rights, though there can be exceptions under certain circumstances, like if dividends are missed for a long time.
How are the dividends determined?
Preferred stock is usually issued with a par value, traditionally $100, and a specified dividend rate stated as a percentage of par. For instance, a 5% preferred stock is expected to pay an annual dividend of $5 per share.
Expected to pay, but not guaranteed.
Exactly. That dividend is not guaranteed if the company performs poorly. The board can choose to reduce or omit the preferred dividend, just like common dividends, though there might be consequences depending on the type of preferred.
Okay, so let's get into those types. Corporations add various features, right? Let's start with cumulative preferred stock.
Right. Think of cumulative preferred as having a dividend IOU.
Then IOU.
Yeah. If a company fails to pay the full dividend on its cumulative preferred stock in a given period, all those missed preferred dividends go into arrears, basically. They're owed from past periods.
And they have to be paid back.
Yes, before common stockholders can receive any dividends at all, the company has to catch up on all the missed preferred payments first. Most preferred stock issued today is, in fact, cumulative.
Okay, let's use the Warp Inc. example. They have 5% cumulative preferred stock, par $100. They missed $3 in dividends in year 1, $3 in year 2, and $2 in year 3.
So that's $8 in arrears.
Yeah.
$3 plus $2.
Right. And then in year 4, the stated dividend is $5 before any common dividends can be paid in year 4.
The cumulative preferred shareholders must receive a total of $13 per share. That's the $8 in arrears plus the current year's $5 dividend. It really does operate like that IOU.
That's significant protection for preferred holders. What's the alternative? Non-cumulative.
Correct. With non-cumulative preferred stock, any missed dividend payments do not accumulate. If the company skips a dividend, it's just gone forever for the shareholders. Poof.
No IOU.
Nope. Only the current year's stated dividend must be paid before common dividends are dispersed.
So using the same Warp Inc., 5% non-cumulative stock scenario in year 4 if the company wants to pay a common dividend.
It only needs to pay the current $5 dividend to the non-cumulative preferred shareholders. Those past missed dividends from years 1, 2, and 3 are simply not owed. Much riskier for the income investor.
Definitely less secure. Then there's participating preferred stock. What does that mean?
Well, preferred stock usually has that stated fixed dividend rate, which acts like a ceiling on the payout.
Right, the 5% or whatever.
But investors with participating preferred stock might receive a greater dividend than that stated rate if the company performs exceptionally well and decides to pay common dividends above a certain specified amount.
So they get to participate in the extra profits alongside common shareholders.
Exactly. So if a 5% participating preferred might potentially pay up to, say, 8% if certain profit or common dividend targets are met. It offers a bit more upside potential.
Interesting. What about callable preferred stock? Sounds like the company can call it back.
That's precisely it. Callable preferred means the issuing company has the right, but not the obligation, to repurchase the stock from the shareholders at a specified price, the call price, at some point in the future.
Why would they do that?
Usually, if interest rates fall significantly after issuance, they might be able to issue new preferred stock at a lower dividend rate, so they call back the older, more expensive shares.
Is the call price just the par value?
Typically, the call price is set slightly higher than the par value, like $105 for a $100 par stock, to offer a premium and make it more attractive to buyers initially, compensating them for the risk of having it called away.
Okay, callable means the company can buy it back. And for those seeking some capital appreciation potential with their preferred stock, there's convertible preferred stock.
Right. This feature adds an element of growth potential. You, the investor, have the option to convert your preferred stock into a predetermined number of common shares of the same company at a specified conversion price.
So you can switch from preferred to common if the common stock price goes up.
Exactly. It offers the potential to benefit from the company's growth, like a common shareholder, while initially having the relative safety and fixed income of preferred stock.
How do you know how many common shares you get?
You calculate the conversion ratio. You simply divide the preferred stock's par value, usually $100, by the conversion price stated in the terms.
So if the conversion price is 25,
Then $100 divided by $25 gives you a conversion ratio of 4 to 1. You'd get 4 shares of common stock for every 1 preferred share you convert.
now, what's truly fascinating here is the strategic decision involved for the investor, especially if the stock is also callable.
Absolutely. The decision to convert, hold, or allow the stock to be called depends on the relative value. Which option gives you more money? The value of the common stock received upon conversion, or the call price if the company calls it?
And the market price of the convertible preferred stock reflects this.
Usually, yes. The preferred stock will typically trade at a price that reflects the better choice for the investor at that moment. It tracks the more valuable option.
Let's use the RMO example. 5% convertible preferred, callable at $102. It's convertible into 2 shares of RMO common. The common stock is currently trading at $55 per share.
Okay, so the call price is $102, but what's the conversion value?
2 common shares at $55 each. That's $110, $55 by 2.
Right, so the conversion value, $110, is higher than the call price, $102.
So what will the preferred stock trade at?
In this scenario, the convertible preferred stock will likely trade near $110, reflecting the underlying common stock's increased value rather than just the lower $102 call price. The conversion option is more valuable, so the market prices it accordingly. It's clever how it adjusts.
Very clever. Moving beyond the standard stock types, let's explore rights and warrants, which our sources define as specialized equity derivatives.
Right, derivatives because their value is derived from the value of the underlying common stock or another asset.
A key concept here is preemptive rights. You mentioned these briefly. An exclusive privilege for common stockholders.
Yes, very important. If a corporation decides to issue more common shares to raise capital, existing shareholders often get a rights offering.
What does that mean?
It gives them the opportunity, the right, to purchase a proportional number of the new shares before they're offered to the general public.
Why offer them first dibs?
To allow them to maintain their percentage of ownership in the company and prevent their existing stake from being diluted by the new share issuance. It protects their ownership level.
How does the offering work?
In a rights offering, existing common stockholders automatically receive 1 right for each share they already own. These rights allow them to buy the new shares at a preset subscription price.
Is that price favorable?
Usually, yes. The subscription price is typically set below the stock's current market value to make it attractive. But these rights have a limited time window. You have to act relatively quickly, often just a few weeks.
Okay, quick example. Warp Inc. has 1 million shares outstanding, plans to issue another 1 million. An investor owns 100,000 shares, that's 10% of the company.
Right. So under preemptive rights offering, she would receive 100,000 rights because she owns 100,000 shares.
And those rights let her buy.
Depending on the terms, likely 100,000 of the new shares at that favorable subscription price, allowing her to maintain her 10% ownership stake in the now larger company, 200K shares at a 2 million total.
What can she do with the rights? Keep them.
She has options. She can exercise the rights and buy the new shares, or because rights are transferable, she can sell the rights themselves to someone else in the open market if she doesn't want to buy more stock.
Okay, rights are short-term, below market price for existing shareholders.
Mhm.
And then there are warrants. How are they different?
Warrants are another type of derivative giving holders the ability to purchase common stock at a specified subscription price in the future, similar to rights. But there are key differences.
Like what?
Warrants have much longer maturities, often years, sometimes even perpetual, meaning they never expire. Rights are very short term.
Years versus weeks. Big difference. What about the price?
The subscription price for a warrant is usually set above the current market price of the stock at the time the warrant is issued. The expectation is the stock price will rise above the subscription price over the warrant's long life.
So you hope the stock grows into the warrant price. Why are warrants issued?
They're often issued attached to other securities, like bonds or even units of stock, as an incentive, a sweetener, to make the primary offering more attractive.
Like a bonus thrown in.
Exactly. And importantly, these warrants can usually be detached from the original security and sold separately in the market. They become their own tradable instrument.
When does a warrant actually become valuable?
A warrant gains intrinsic value if the stock's market price eventually rises above its subscription price.
For example?
If a warrant allows you to buy stock at a subscription price of $30 and the stock later trades in the market at $33.
Then the warrant has $3 of intrinsic value.
Precisely. Because you could theoretically exercise the warrant, buy the stock for $30, and immediately sell it in the market for $33, capturing that $3 difference, less any transaction costs.
Okay, so warrants are longer term, initially above market price sweeteners. Got it. Finally, let's touch on some essential equity rules for investors that our sources highlighted. Regulations.
Right, a couple of FINRA rules and an SEC rule are worth knowing.
First, Financial Industry Regulatory Authority, or FINAU, Rule 200-261. Disclosure of financial condition. What's this about?
This is pretty straightforward. It establishes your right as a customer to request and inspect your brokerage firm's most recent balance sheet. They have to make it available to you if you ask, usually electronically. Transparency about the firm's health.
And good to know. Then there's FINRA Rule 2262. Disclosure of control relationship with issuer. Control relationship.
This means if your brokerage firm is controlled by or is under common control with the company whose stock you're buying or selling through them.
Ah, like if the brokerage owns the company or vice versa.
Exactly. The rule says the brokerage firm must disclose this control relationship to you, either before or at the time of executing your transaction.
So the example given, if you have an account at, say, LRR Investments and you're buying stock in LRR Incorporated.
LRR Investments must tell you, hey, just so you know, we have a control relationship here. It's all about disclosing potential conflicts of interest. Transparency again.
Makes sense. And wrapping things up with SEC Rule 10b-18 purchases of certain equity securities by the issuer. This is about companies buying their own stock back.
Yes, specifically regulating how companies buy their own stock in the open market, the secondary market. We mentioned treasury stock earlier. This rule governs how those buybacks can happen.
Why regulate buybacks?
To prevent companies from manipulating their stock price upwards through aggressive buying. The rule provides a safe harbor.
A safe harbor.
Meaning, if a company follows the specific conditions of Rule 10b-18 when conducting buybacks, the SEC generally won't deem those purchases as manipulative. It protects companies doing legitimate buyback programs, like returning capital to shareholders.
What are some of those key conditions for the safe harbor?
There are several. For instance, the company generally must use only one broker-dealer per trading session to conduct all its buybacks.
Okay, one broker a day.
They're also generally prohibited from making purchases during the very first reported transaction of the day, and importantly, within the last 30 minutes of the normal trading day.
Not at the open or close. Why not the close?
To avoid influencing the crucial closing price. For very actively traded stocks, that last window is shortened to 10 minutes.
Okay. Any price limits?
Yes. The price the company pays cannot be higher than the highest independent bid currently available, or the last independent transaction price, whichever is higher. They can't lead the price up.
And volume limits, like the insider selling rule.
Similar concept. The total volume of shares the company repurchases on any single day generally cannot exceed 25% of the stock's average daily trading volume, ADTV, over the preceding 4 weeks.
25% of ADTV limit.
Okay.
So these rules together provide guardrails for buybacks.
Exactly. They allow companies to repurchase shares for legitimate reasons while preventing manipulative practices that could harm investors.
Well, we've certainly taken a comprehensive deep dive into equities today. Wow, we've unpacked everything from the fundamental structure of corporations to the nuances of different stock types, shareholder rights, and those crucial rules that govern buying and selling.
Yeah, covered a lot of ground.
We truly hope this has provided you with a clear, engaging shortcut to, really understanding this vital part of the financial world.
So what does this all mean for you, the listener? Beyond just understanding investment vehicles, which is useful, how might a deeper understanding of these equity nuances inform not just your investment decisions, but maybe your broader understanding of corporate power and influence in the global economy? Something to think about.
Definitely something to think about. What insights stood out to you from today's deep dive? Keep exploring, keep questioning, and keep digging into the fascinating world of finance.